2 days ago, silver did something it hadn't done in decades. It exploded to 82.50, and within hours, not days, within hours, it dropped 15 to 16% off the peak. But here's what almost nobody is talking about. This wasn't just profit taking. This was forced liquidation. The exchange hiked margins twice, back to back, while traders were still celebrating new highs. And if you felt that sick feeling in your stomach watching your positions get slammed, good. That means you're awake. Because what we just witnessed isn't the end of anything. It's the beginning of the most dangerous and most profitable phase of this entire metals cycle. Right now, you have about 14 days to decide what kind of player you want to be. The careful one who survives what's coming, or the one who gets absolutely destroyed thinking volatility means momentum. And I'm going to show you exactly why the next 2 weeks will separate the professionals from the amateurs, why the crowd is about to get milked harder than they can imagine, and why the smartest move you can make right now might feel completely wrong. Let's get something straight from the start. When a market rips 11% in a single session and then wipes out most of that move almost immediately, it's not telling you the party's over. It's screaming something much louder. It's telling you liquidity is thin, emotions are running nuclear hot, and weak hands are getting shaken out violently. This is textbook late cycle momentum behavior. And if you think this is only about silver, you're already 3 steps behind. Platinum pulled the exact same stunt. Massive spike, massive reversal, all within a handful of sessions. That's not healthy trending price action, that's crowding. That's everyone trying to rush through the same exit door at the same time. So here's our first hard truth. The move itself isn't the headline, the speed of the reversal is. Because speed is what creates forced behavior, and forced behavior is what creates opportunity if you know where to look. When margin requirements jump, your broker doesn't care about your thesis on monetary metals or dollar debasement. They care about one thing, your collateral. And if you're leveraged long on silver and the rulebook changes mid-game, you don't get to hold through it and wait for vindication. You get liquidated. And when that happens, everything correlated to your position gets sold too. Mining stocks, other metals, even positions you never planned to touch. This is why the sell-off felt like it hit across the entire complex, because it did. Now watch this. Most traders are staring at silver sitting in the mid-70s right now and convincing themselves the worst is over because price stopped falling for a few hours. But here's what they're missing. Stabilization is not safety. Silver hovering after a violent correction doesn't mean the storm passed. It means the storm is reloading. Sideways action after a shock is the market coiling the spring again, and when it releases, it's going to catch people off guard. The candle that actually matters is the one we just printed. That massive red body that swallowed the prior day's green move. Traders call it a bearish engulfing pattern. We call it a warning flare. Not a prophecy, but a flare. And those reversal signals have a short shelf life, typically 1 to 3 sessions where the market is hypersensitive. After that, price can chop sideways, lure you into comfort, and then explode in whichever direction when you're mentally exhausted. So the real question isn't whether the bull market is done. The real question is this: who's still trapped and who still has to sell if we get another volatility spike? Because that's where the next danger lives. And here's what nobody wants to admit. We are deep inside bubble behavior right now. That doesn't mean sell everything and hide under your bed. It means moves become emotional, targets get wildly overshot, and reversals happen so fast people genuinely start questioning if the rally was even real. Both things can be true simultaneously. We can absolutely see silver punch toward triple digits and still watch it slam back down so violently that half the people who bought the top swear the entire move was manipulation. And this is the mistake almost everyone makes. They think a price target is a binding contract. Silver to 100 is not a promise, it's a scenario. If liquidity stays available, if forced selling pauses, if buyers keep absorbing supply, then the upside case gets stronger. But if margins keep climbing and volatility keeps spiking, the downside case strengthens instead. That's how this works. Facts first, then probabilities. Now, why is $100 even on the table as a real possibility? Not because it sounds impressive. Because once you clear the big psychological resistance levels, 50, then 80, the percentage move required to reach 100 gets smaller. The market doesn't need a miracle at that point. It just needs continuation. But continuation, late in a cycle, is messy. It's a staircase up with trapdoors hidden between the steps. So what do we actually watch to know whether the next push higher is legitimate or a trap? 2 things: the behavior around key technical levels and the behavior of market participants. Key levels are where professionals act. Measured move targets, Fibonacci extensions, algorithmic profit zones. When silver runs into those areas, it often triggers mechanical selling. Even if the fundamental story is wildly bullish, that selling isn't bearish, it's just mechanical. And when mechanical profit-taking collides with emotional late-stage buying, you get exactly the candle sequence we just lived through. Expansion, exhaustion, partial rebound. That sequence is the market's brutal way of saying, welcome to the blender if you're late money. Now here's the fourth thing you need to understand. The next truly massive opportunity usually comes right after the big scary correction. I know that sounds backwards, but markets absolutely love punishing the largest crowd. And right now, the crowd is leaning heavily bullish on metals. You can feel it everywhere. Every person who ever wanted exposure to hard assets is suddenly wide awake. Every timeline is flooded with content about miners, silver, platinum, the new monetary era, and that is precisely when risk is at its highest, not lowest. Because crowded trades don't unwind politely with advance notice. They unwind when the last buyer is fully committed and then the rug gets violently yanked. So if we're being honest with ourselves, the highest probability path forward looks something like this. One more emotional push higher, possibly a spike that makes headlines, and then a correction that genuinely shocks people who thought volatility just meant upward momentum. Could that correction be 20%? Could it be 30%? Absolutely possible. And if the move is truly parabolic before it breaks, the snapback can happen faster than your brain can process what's happening. This is where people get absolutely destroyed, not because they were wrong about the long-term thesis, but because they couldn't survive the short-term chaos. Let's talk about the new floor concept because this is where smart viewers separate themselves from the noise. A floor isn't just a number you repeat in the comments. A floor is a price level where selling genuinely dries up because value-oriented buyers step in with size. If silver truly built a structural regime shift above 50, then even after a blow-off top and correction, it can hold above that zone and base for the next leg. That's the bullish long-term thesis. But inside that thesis, we can still see a deep pullback into the 40 to 50 band. That wouldn't break the structural story. It would just reset positioning and flush out weak hands. And resets are where disciplined traders get paid if they have patience. So ask yourself something uncomfortable right now. If silver dropped to 48 tomorrow morning, would you panic and hit the sell button? Or would you recognize it as a potential base building zone and an opportunity? If your honest answer is panic, then you're not properly positioned. You're over-levered emotionally, and that's a recipe for disaster in what's coming. Now watch the cross-market signal that most people ignore. Gold has been trending stronger and cleaner than silver, but it's not immune to what's happening. When gold grinds steadily higher and then starts to spike vertically, that often signals stress brewing somewhere else in the system. Gold doesn't scream higher because everything is fine and calm. Gold screams because someone with serious size is buying protection. That's why gold can absolutely make a run toward the low 5,000s, maybe 5,100 or even 5,200 in a perfect storm scenario and still correct sharply afterward. One more liquidity injection, one more fear bid, one more chase by institutional players. But if that happens, the correction risk doesn't decrease. It increases because parabolic vertical moves create massive air pockets underneath them with no support. So the question becomes brutally simple. What are you actually trying to do here? Are you trying to be right about the decade-long trend? Or are you trying to survive the next 3 months with your capital intact? Because plenty of people are absolutely right about the long-term direction and still get completely wiped out short-term by excessive leverage, poor timing, or overconfidence. We don't need to be those people. We need a plan. And the plan isn't complicated. It's just extremely hard to follow when everyone around you is screaming. We stay anchored to the primary trend, but we respect volatility as a serious warning signal. We assume one more push higher is possible, but we absolutely don't assume it's free money. We treat margin hikes like landmines in a field because they force immediate behavior, and we watch for signs of exhaustion across the entire complex, metals, mining stocks, the whole basket. Because when synchronized froth appears across correlated assets, it usually ends together, not separately. Now let's talk about mining stocks, because this is where most people get absolutely crushed. Miners can leverage the metal's move on the upside, sometimes doubling or tripling silver's gains, but they can also get destroyed when liquidity pulls back, even if the underlying metal holds up relatively well. So when do miners actually become the clean trade? Usually after the correction, not during the blow-off phase. Why? Because during the blow-off, the market stops discriminating. It buys anything with the right ticker symbol. That's when absolute junk rallies hard and quality names get ignored. After the correction, the market becomes selective again. Real bases form. Balance sheets start to matter. Jurisdictions matter. Hedging strategies matter. Management quality matters. And if we're wrong about this setup, where will it show first? It will show in the sector leaders. The strongest names will stop making new highs. Even if the metal tries to push higher again, that divergence between the metal and quality miners is usually the first structural crack. That's your early warning system. Let's go back to the margin story again, because this is the actual engine driving the chaos. When an exchange raises margin requirements, it's like a casino suddenly raising the minimum bet while you're already sitting at the table with your chips committed. You either bring more capital immediately or you leave the table. And most players don't have extra capital sitting around. They have opinions and positions, so they're forced to sell. And that selling cascades through the system like dominoes. This is why margin hikes matter infinitely more than 1,000 headlines about supply shortages or industrial demand. The margin rule change is immediate and brutal. The fundamental thesis plays out slowly. So here's the critical question we need to ask right now. Are we currently in a fundamentals-driven market or a positioning-driven market? In a fundamentals market, data and supply-demand dynamics matter more than leverage. In a positioning market, leverage and who's forced to act matters more than the data. This past week, leverage clearly mattered more, which means the next significant move depends entirely on whether the forced sellers are actually finished. If forced selling is complete, the upside can reassert itself extremely quickly. If it's not done, the next downdraft can be genuinely ugly, and you won't see it coming in a press release or analyst report. You'll see it in the tape, in real-time price action. Let's make this immediately practical. If you're actively trading, you need clean invalidation points, not vibes, not hope, not guru predictions, specific price levels where if they break, the story you're trading is objectively wrong and you exit. And if you're investing for the longer term, you need to size your positions so that volatility can't psychologically bully you into panic selling at the worst possible moment. Because the entire game right now is psychological warfare. They want you feeling nauseous. They want you watching every single tick. They want you to quit at the exact moment before the next major leg begins. We're not playing that game. Silver is trapped in a range after a massive shock. And ranges are absolute magnets for fakeouts. You're going to see breakouts that look completely confirmed, and then they'll reverse violently and destroy anyone who chased. That's what volatility clusters do. They feed on certainty and punish it mercilessly. So we need to stay humble and flexible. Possible upside scenario: one more surge higher, a fast spike toward 90, maybe even a print with 3 digits that creates a media frenzy, and then a sharp reversal as margins and profit-taking collide. Possible downside scenario: the range resolves lower, the 70s fail to hold, we dip into the 60s, and the real test becomes whether buyers defend the former breakout zones. Most likely scenario: chop, fakeouts in both directions, exhaustion, and then a decisive move when people are mentally tired. That's the actual tape. Here's the single most important mindset shift for navigating metals in 2026. Stop treating volatility like entertainment or confirmation of your thesis. Volatility is information, pure information. It tells you exactly where leverage is concentrated and where emotion is running hottest. High emotion equals poor decision making. Poor decision making by the masses equals opportunity for disciplined players. That needs to be us. What about physical metal holdings? Here's the honest answer. Physical is slower to trade. You can't tap out with one click when you panic. That's actually good for long-term conviction, but it's still fully exposed to price swings. The question isn't should you hold physical forever through anything. The question is, are you genuinely willing to endure a deep 30 or 40% correction without regret or panic? If yes, then fine, you're positioned correctly. If no, then you need a plan to systematically lighten exposure into strength and reload into weakness, not because the thesis dies, but because cycles breathe. And cycles in metals can be absolutely brutal. They can correct for months, even an entire year, while everyone on social media screams about manipulation and imminent moon missions. Meanwhile, smart money is quietly building positions during the base. We want to be the smart money, not the loud money. Now let's address the elephant nobody wants to talk about. People keep saying this time is different, and here's the truth. The news cycle is always different. The specific catalysts change. But price psychology? That never changes. Greed looks identical across decades. Fear looks identical. Crowding looks identical. Forced selling looks identical. That's exactly why charts rhyme across different eras. So when we compare this current phase to prior blow-off tops, we're not saying history repeats perfectly tick for tick. We're saying the human being behind the buy button hasn't evolved. And our job is to exploit that consistent psychology. Here's the actual play. Keep your eyes locked on the next 2 to 3 monthly candles. Because if this is truly late-stage acceleration, the final top can form within a couple of months, not a couple of years. The steepest, most seductive moves happen right near the end, and they seduce you into thinking you finally made it, that you timed everything perfectly. That's exactly when you need to be most disciplined, most skeptical of your own emotions. Let me ask you something brutally honest. If silver prints 99 or even breaks 100, will you feel euphoric? And if you do, will you have the actual courage to take profits when everyone around you is screaming it's going to 200 or 300? That's the real test. Not your thesis, not your research, your emotions under pressure. Now bring gold back into this picture. If gold pushes into the low 5,000s and then starts to roll over, that's your macro signal. Gold leading downward often drags silver and miners with it, even if silver looks structurally strong on its own. Because liquidity is a tide. When it goes out, it takes every boat with it regardless of quality. And if the broader equity market wobbles, especially in this early year window, we could see a rotation that makes metals violently volatile and makes miners temporarily untradeable. But that doesn't kill the structural bull market. It creates the setup for the next major leg higher. And that next leg is where miners can truly explode, but only after they base, after weak capital gets flushed, after the market stops buying everything and starts buying actual quality. So what do we watch for? Base building. We watch for the moment where bad news stops pushing price lower. That's the technical signal that sellers are exhausted. We watch for the moment where silver dips and gets instantly bought without drama or fear. That's genuine strength, not a bounce. And we watch for premiums on physical metal and tightness in the actual physical market, because the paper futures chart can absolutely lie short term. Quick reality check before we finish. Even if we do spike above 100, it might be extremely short-lived, days, maybe weeks, not a new permanent plateau overnight. If we accept that reality in advance, we stop chasing candles emotionally. We let the market come to us. We let the crowd do the emotional, exhausting work. And we take the calculated other side when risk gets mispriced. The next 2 weeks are critical. The market just showed us its teeth. Margin hikes, blow-off spikes, violent reversals. This is not normal, calm price behavior. This is a transition phase. And transitions are exactly where fortunes get built and where overconfident traders get completely erased from the game. So keep your position sizes sane, respect the leverage triggers like your trading life depends on it, and remember this. The real opportunity usually arrives right after the crowd collectively swears the story is completely dead. One final thing. If we get another margin hike while silver is still trying to stabilize in this range, the next move could be faster and more violent than the last one. And when that happens, the chart won't politely ask for your permission or give you time to think. It will just move. And here's the last clue that most people will completely ignore. Watch the quality of any bounce. If we rip higher on low volume, that's just sugar, a temporary relief rally. If we rip while open interest resets and physical premiums stay firm, that's actual stake, real demand. They want you staring hypnotized at the spot price while the real stress shows up in positioning, spreads, and who can actually still hold their positions. If this analysis is wrong, it will show up first in a failed rally that can't reclaim the prior high. If we're right, the squeeze resumes without warning and without mercy. Stay sharp.